Good morning, everyone. Welcome, bonjour. That's about it. I can do two languages outside of English. About 20 years ago, I was sitting in one of these rooms at Stanford University, and there was a professor that said something to the class. I typically sit in the back benches because I couldn't bother much with lectures back then. And he was talking about risk. And every entrepreneur here in the room has some idea of risk-reward trade-offs. And he mentioned the concept of the greatest risk of all is a risk of not doing what you want on the bet that you can buy yourself the freedom to do it later. And I sit here in this room, or standing in this room, with some incredible entrepreneurs that have traded a lot of financial stability, a lot of less risky careers to really follow their passion. And the one thing that I will say is the only people that do incredibly significant things in their life, not just successful things, are people that have a healthy obsession. I was asked a couple of weeks ago by the Africa Arena team to talk about something that's not often spoken about, which is what is the... Hello? Check. Journey when you raise a fund. Our fund, Launch Africa Ventures, which was born out of almost 7 years of running accelerators on the continent, focuses on themes that are increasingly difficult for international investors to understand. There's the Africa risk, there's early stage risk, there's technology risk, there's currency risk. So 2 years ago, of co-running with my co-founder Philip, who's sitting this technical. It was one of the hardest things to do. There are a lot of fund managers that want to understand, how can I get more involved in VC? How do I talk to LPs? And what are some of the tips that you have as a fund manager to, should I just use that? Okay.
Check. Oh, it's much better. So, who are we? So Launch Africa launched about 2 years ago in the midst of COVID to attempt to be one of the only truly Pan-African funds that invests in pre-Series A, seed and pre-seed companies across the continent, to shake up an ecosystem that traditionally has only been run by friends, family, and angel investors. It was a very bold thing. And just like almost every entrepreneur here, we got a lot of no's. People doubted us. And there will always be people, and hear me out here, that will wish for your failure. Because fundamentally, even though human beings are good people, when you go against the grain as entrepreneurs and you want to build something and you have a healthy obsession with something, people will always look back at you and say, you can't do it. But when you achieve that threshold, all of a sudden, everyone wants to be part of that success, right? Failure has a lot of whiners, and victory has a lot of people that want to be part of it. So here, I thought I'd just spend 20 minutes talking about if anyone here wants to support entrepreneurs, and I'm assuming people are here because they want to support entrepreneurs, what are some of the tips and challenges and how you overcome them that you will never learn at business school, on how you can successfully launch an emerging market VC fund to help the ecosystem, even if it means going against the grain and doing things that traditionally aren't accepted, right? So, some facts. We are a $30-odd million fund that is now invested in 120 technology startups across Africa from 20 different countries. We've done 4 investments in Tunisia, quite a few in Egypt and Morocco. And alongside our LPs that number more than 200, again, we've broken a lot of rules in venture capital. And I'm here to tell you that as an entrepreneur, do not be afraid of breaking rules and challenging conventional wisdom. Don't be a rebel without a cause. Be a rebel with a cause. And that's how you build significance, not just success. So what did we do? One of the things about funds is getting your structure right. That beautiful island you see on your right is Mauritius. And there's a reason why I talk about it. Traditional venture capital, as we heard in the last panel, is dominated by big institutions. So DFIs, all the three-letter acronyms you can think of, CDC, FMO, ABC, XYZ. And if you look at the amount of capital that DFIs have put directly into companies and through funds, DFIs probably control more than 85%. And I think my friend Ibrahim from Sawari mentioned this the other day. Where's Ibrahim? Is he here? No. So the majority of individuals and families that are intellectually curious about helping startups in Africa have no way to help them unless you invest directly into companies. So what did we do? In Mauritius, you have multiple fund structures that allows individuals to become shareholders in companies and not LPs. So you have the economics of an LP-GP structure, but the ease of administration of a company. So we broke a lot of rules, just like you founders do, and we set up a company where we could take in checks as little as $10,000, where you have Tunisians, South Africans, Kenyans, Nigerians that live outside of the continent that want to help founders on the continent, and they could do it through a structure that previously excluded the vast majority of investors. The vast majority of funds will not allow you to be an LP unless you have $1 million of liquid assets outside of your primary residence. Did you guys know that? Right? So when you set up a fund to invest in early stage entrepreneurs like yourselves, always think of the structure and how you can move things around to help the ecosystem. For every action, I mean, Newton said, for every action there's an equal and opposite reaction. So with every decision that you make that bends the rules, have a reason for it. LPs, to popular opinion, are actually very nice people. You just have to have conviction as to why you're doing something. LPs get a bad rep, but LPs want to know that you as the GPs understand why you're doing something, what are the pros, what are the cons, and they're actually really nice people. We have 238 LPs in our fund, and we are on good terms with 99% of them. Number two. Gosh, why is this? Oh, there we go. Waterfalls, right? As a GP raising a fund, be very, very clear on your fund life, your fees, your carry structure, your capital call procedures. And here's an important thing. It doesn't matter what the structure is, or what the waterfall structure is, or what the fees are. You have to have a reasonable justification for why you do it. I'm going to repeat this throughout the presentation. LPs, corporate partners, do not care what the structure is, but you have to understand why. So in our fund has 7 years. Most venture capital funds have between 10 and 15-year useful fund lives. 5 plus 5 plus 1 plus 1, 3 plus 5 plus 2 plus whatever. Our fund's 7 years. And there's a reason why it's 7 years, because early stage investing in Africa has been dominated by institutions coming in very late, expecting larger funds to buy out or take out significant parts of C and D and E rounds. Little liquidity for angels like a few of you here, right? And the vast majority of Series B and Series C rounds in Africa are massively oversubscribed. So we decided that the only way we could galvanize more angel investors to invest in tech startups, to become LPs in early stage funds, was to change the way we looked at exits. The vast majority of our exits, not just in Launch Africa, but even the fund we ran before this at Startup Bootcamp, is through secondaries. And why are secondaries important? Until about 3 years ago, the vast majority of founders, let's say hypothetically a founder was raising a $5 million Series A at a pre-money of $20 million. And we spoke about this during the unconference. The majority of founders do not own more than 50% of stock in their own company post-Series A, which is a crying shame. So one way of circumventing that and not under-allocating money to interested investors is to allow a certain limited amount of secondaries for early investors. Because let's be honest, beyond the seed and seed extension phase, angel investors don't really add a lot of value. And it's okay to provide liquidity. And I take it one step further and even say founders don't want to be living on peanut butter sandwiches and toast and scrambled eggs the rest of your life, living in their parents' basement, because share certificates don't pay school fees. What do I mean by that? You need to be able to have a certain amount of liquidity as a founder that justifies the need for you to continue going to work every day, hoping that one day you're going to become a $100 million company or a unicorn. So investors need to be more okay and off the table, even if it's just a tiny amount. So a big part of our fund strategy is to do secondaries, and it's happened. What you will not see in the media, by the way, is when you see these mega rounds announced by companies like Flutterwave, Kuda, Aerobotics, InstaDeep, all the big InstaDeep in Tunisia, is a big part of these rounds include secondaries that is never reported in the media. Why? Because it's never disclosed. When a big fintech in Africa did a massive Series C round, I won't mention who, almost 30% of the round was secondaries, right? So again, as a fund, be able to justify your fund life and just be confident about it. And LPs will eventually understand. Is nothing changing? Sorry. It's just really slow. There we go. One of the things that GPs, right, venture capital in Africa is at best 9 to 10 years old. So no one expects you to be a fifth-time fund manager with 21 exits. But the reality is a track record as an angel, your track record as an angel syndicate, your track record as an accelerator is all very important. So don't expect to be able to convince people that you are able to manage their money if you can't show concrete examples of how you've delivered returns for your stakeholders. And use case studies whenever appropriate. The number of decks on companies that I've seen that don't have case studies is absolutely shocking. Number 4, the ideal setup for any VC fund, similar to a startup, is you've got to run your fund like an investment bank. I used to be an investment banker in the 20s. And you've got to have a front office, a middle office, and a back office. Running a fund where, as the GPs, you're not able to talk to LPs, so you've got to have a team that screens, identifies sources, and vets deals, pushes it to your IC, and have a team that looks at portfolio synergies, investment tracking, reporting, and post-investment monitoring. Running a fund is not an easy process. It's one of the hardest. It is about 10 times harder to raise money for a fund than it is to raise money as a startup founder. And you have to be super methodical in how you structure the front office, middle office, and back office responsibilities. I've seen quite a few fund managers who want to run VC funds, and you've got 2 GPs and maybe an analyst. And then you wonder why they struggle to raise money. And that leads into another point, which is conviction about how you source your deals. Almost every LP will ask you very direct questions about how you source deals. As a fund, you have to have a unique selling proposition that as to why you and why not someone else from a deal sourcing perspective. It could be your relationship with accelerators, it could be your relationship with corporates, it could be your relationships with syndicates. But we're getting to a point where the power balance that used to sit with investors is slowly but surely shifting to founders. So unless a VC is able to tangibly deliver 4, 5, 6 reasons why they can add a lot more value than just their money, you will be not just priced out of deals, you will be shut out of deals. So you've got to be able to really convince why you as a fund, and these are just tips for fund managers, why your fund will get the best deals, and that will also lead into the type of instruments you use. So when you do an early stage fund, how many of you have raised money as founders and have done priced rounds in your first or second round of funding? Priced rounds as in common equity, preferred equity. What is the average time it takes to do a priced round from a legal standpoint? So I'll give you some perspective. Yeah, about 4 or 5 months, right? So until about 3 or 4 years ago, the average African startup would spend 4 to 5 months raising a $500,000 to $1 million seed round. And what is the average runway that startups have when they raise seed capital? 9 to 12 months. So you're now spending between 50 to 60 to 70% of your time raising money. And then what happens from a runway perspective? 3 months later, you're raising money again. And a big chunk of that is because of the huge amount of time it takes for legals. So about 13 years ago, sorry, not 13 years ago, 10 years ago, safe notes were introduced by YC. There are similar structures now called KISS notes and BSA heirs. But the reality is, as an early stage fund, if you take more than 8 weeks to make a decision on a pre-Series A startup, you will lose out. It's as simple as that. So your role as a good fund manager is to eliminate every single time period. So you basically have 4 to 5 major types of DD. There's legal DD, there's technical DD, there's operational DD, financial DD, and the fifth one, which almost everyone forgets, is human DD. Now, using convertible notes, safe notes, and instruments like that can literally shrink your legal DD time from a term sheet perspective to a couple of days. Working with accelerators, where you have prominent organizations like Amazon Web Services, Microsoft Azure, Google Cloud, etc., doing detailed tech audits on companies before you even take them to IC, will typically shrink your technical DD down to less than a week. So the whole point is you've got to be able to, as a fund manager, clearly articulate how you can do something in a thorough manner, but efficiently. And this is how you build traction in the industry and are truly founder-friendly, but still conform to industry standards. Like I mentioned earlier, what is your exit strategy? One of the hardest things in a fund that people don't talk about is constructing your portfolio. These are some tips for founders. How many of you as founders, the energies, I can tell it before lunch, so people are a bit hungry. How many of you as founders do active DD on your investors? And how many of you go and look at an investor's portfolio before you even approach them? I see a couple of hands. And that's the problem, right? Do you know how attractive it is to a VC when a founder comes to you and says, hey, I'm so-and-so, I'm building this platform for this industry and these are my users? Everyone hears that all the time. But if someone says to you, I noticed that you've got this company in your portfolio and you backed them 6 months ago and they're doing reasonably well, but they're struggling with this. I think in addition to us being a potential company for you, helping you with this, we can help your portfolio companies. One of the hardest things for VCs to do is construct portfolio where they optimize how portfolio companies work with each other. Of them. Andreessen Horowitz is another one, and there are a couple on the African continent that do this well. But one of the quickest ways to get the attention of good VCs is to really understand optimization within their portfolio. If you can fit a cog in their wheel that makes the lives of their portfolio companies better, it is so easy to get into a VC fund's IC. But way too often, even last night, I had founders approaching me at the VC night and just literally sending us decks. How does that help? It just reeks of spray and pray. Do you know when you cook spaghetti and you literally throw spaghetti in the wall? If it sticks, al dente, it's good. And it's the stupidest, but I see why people do it, because it's the law of averages. But you really have to respect the process and understand, why would someone give you money if you don't make the effort to understand how it benefits them, right? And that's a big part of how VCs work, is we construct our portfolios to make sure that we're not just betting on single horses, we're betting on horses that can work together, right? A couple of slides, I just thrown up a few memes. This is from a series called The Office. Communication. One of the most important things, and not just in the VC world, in partners, husbands, wives, parents, children. When in doubt, over-communicate. From a fund perspective, as founders, over-communicate with your investors. No one in the history of venture capital told a founder, can you please stop sending me so many reports? Did anyone say that? The same thing with GPs. But at the same time, understand who calls the shots. LPs don't run your fund. You do. You're accountable to them, but they don't run your fund. In the exact same way that investors should never run a company. So what does that mean? Have a clear communication strategy. If it's quarterly reporting, if it's semi-annual portfolio reports, if it's annual financial statements, be very clear about how you communicate. And set clear boundaries of what you expect from them and what they expect from you. And err on the side of over-communicating. I'm going to try and breeze through this in a minute, but these are some ways in which VCs should be adding value outside of just your capital. And I would encourage any founders here, in your first or your second meeting with a VC, question them, right? So here are a few things that VCs should be doing outside of just your capital. A VC should be introducing you to other investors. It could be their own LPs. It could be other funds that they actively co-invest with. But you need to hold your VC accountable. So good VCs will always be introducing you to other investors, either for the same round or for future rounds. The number of VCs that don't do this is actually shocking. VCs should be helping you with media exposure. As a founder, there's a concept called confirmation bias, where you think you're the best thing since sliced bread, and you think that you deserve to be on Bloomberg, on Forbes, on TechCrunch. No, you don't. Maybe you do if you've achieved a certain amount of success and traction. But guess who gets media companies to listen to them? It's your investors. And it's the same thing in life as well. The moment you have third-party validation for what you do, it suddenly is just taken more seriously. So hold your VCs accountable. Tell them what you've done, and ask them if you think it's worth helping with media exposure. And by the way, media exposure comes in many ways. It's not just press releases. Talk to your VC and say, hey, I'd really like to be at Africa Arena. I'd love to be at Web Summit. Could you help me get into South by Southwest? Or digital virtual conferences. Ask your VCs to help you with media and PR. And if they don't, that is a slight red flag. VCs have the single biggest challenge that founders have outside of capital, and often the most important thing, increasingly, is talent. There is an acute shortage, not just of developers, software architects, designers, UX and UI experts, digital marketing folks. VCs have dozens, scores of applications and really high quality talent that they see every day, that they should be helping you with. I'm not asking you to make your VC an HR recruitment firm, no. But they have to proactively help you if you reach out to them. So digital talent is extremely important. Ask your VC for help with things like IP, holdco-opco structures, legals when you move into different geographies. How do I set up? Do I set up a branch in if you're in Tunis and you want to expand to Morocco? Hey, Mr. VC, that's backed us. Can you help us with some ideas around cross-border expansion, access to lawyers, tax advisors? Right? There are a lot of things that good VCs do that makes them stand out. And what's in it for the VC? Often VCs that do this consistently get much better terms on deals. So it's actually a very selfish thing. But you have to be able to do that genuinely and consistently with your founder's best interests in mind. So non-financial value add, an extremely important thing, especially at the early stage. Right? And hold your VCs accountable. Setting up a fund. I love this slide. So the majority of VC funds for years, decades, would typically have 2 partners, maybe 3. And if you had your classic 2-20 split, the 20 points of carry would be split between who? The 2 GPs, 10 points each. Bob's your uncle. Right? In today's world, what do you think the average number of months or years, I'm giving you a hint there, is that Gen Zs and younger millennials stay in one company? I'll give you a hint. In my father's generation, it was around 25 years. My father worked at the central bank of a big Middle Eastern country for 42 years. In my generation, I'm 40, it's about 7 to 8 years. What's it in the current Gen Z, well, young millennial generation? What do you think? I dropped a hint earlier. It could be months or years. It's about 18 months, the average. Now, if you live in a world where brand loyalty, company loyalty is at all-time lows, and the switching costs are so low, you cannot pay someone out of their way to make them stay. Employees are motivated by so many different things. Culture. What is your policy towards environmental, social, and governance? Benefits. Carbon footprints. Flexible working hours. Travel. Something that we could never have thought about a generation ago. But let's talk economics for a second. I'm going to pull up Mohammed in the crowd here because he's one of our store employees. You gotta really, if you wanna work with millennials and Gen Zs, you really, really have to understand what motivates them. Back in the day, if you had an offer from JP Morgan or McKinsey and they paid you $100,000 a year when you were 25, you would take it with your eyes closed, right? Some of you may still do that. But the reality is, if you actually pay attention, if you're a boomer or a Gen Xer, and you actually make an effort to go and see what motivates young people to work, you'd realize that it's a lot different from just money. So, as an example, in our fund, our carry structure, assuming you guys know what carry is, 40% of our carry, 37.5, but yeah, close to 40% of our carry is shared outside of the GPs. Something completely unheard of. So analysts, venture partners, investment committee members, board members, everyone benefits when the fund benefits, not just the partners. And you'd be amazed how incredible amounts of talent you can get. And think about this, by the way, as founders, it's not just for funds. Have you really gone into the mind of your employees like we go into the mind of our employees at a fund? What motivates them? Have you asked them? You know, what is the interview process at tech startups or at funds? Right? One of our employees turned down a massive, massive salary at a very prominent investment bank to come and work for us. Because we understood that things like social validation, the ability to have a significant role in an organization is often more valuable than just money, right? So really understand short-term versus long-term incentives as a founder or as a fund manager. And it can often change the attitude and mood in your company. And often that 18-month average period of staying in one company could inch up to maybe 3 years or 5 years or your fund life. Right? Patience. Just like founders will have to spend hundreds of hours on calls with investors, us fund managers spend thousands of hours on calls. So just be prepared for burnout, because it is a real thing. I've lost track, we spent 2 years raising our fund, but 22 months. But you've got to be smart about, a little tip here that you won't learn at business school is, have your initial LP calls with people that will most likely forgive you for screwing up, right? And make mistakes. You've got to have an FAQs, a frequently asked questions list that evolves after every call and make rigorous notes. Do that as founders, by the way, when you pitch to investors. Ask them for feedback. Never, ever, ever take no for an answer. Always figure out why someone said no. No's are good. Long no's are the worst. Just, if that happens, just what's a word that millennials use? Cancel them. But be prepared. Fundraising is a slog. And it gets easier in your second round, in your second fund. As a fund manager, one of the hardest jobs we have is saying no. But have the basic human courtesy. I know this is directed more towards fund managers, but to founders as well. Have the basic courtesy to explain why you said no to someone. The other important thing that is very important from an LP balance perspective. LPs are the ones that fund your fund, and LPs often tend to have reasons why they want to do a deal and why they don't want to do a deal. In our fund, we allow our LPs to send deals to us as referrals, but we make it very, very clear that an LP referral for us is what it is, just a referral. And you've got to have I'm politically correct, you've got to have the cojones, that's a word if I'm allowed to say that, to say no to your LPs. Because you're a GP, right? So normalize being able to say no to founders and to your LPs, because ultimate opinion and our experience, the best deals come from really good founders. Of our 120 companies, I could say the top quartile of our deals have come from founders that are referred other founders. Because founders know how to build companies, LPs don't. A good investor does not make a good founder. So just have those lines drawn in the sand and have a very clear path of communication. I think I'm going over my time, but I'm going to try and go through this quick. Co-investment opportunities. I'm not sure how many funds here have a clear strategy around co-investments. One of the things that we did in our fund as Launch Africa was we allowed each and every LP in our fund, if they wanted to, the opportunity to co-invest in deals alongside us, provided there was space available in the round. Why is it important? It goes back to being founder-friendly. Founders spend way too much time raising money. Now, if you're a GP, and in our case we have a lot of LPs, but even if you have just 20 LPs in your fund, if you tell a founder, we're going to lead you around or co-lead you around, and guess what? Whatever is left that you need to raise, we will take that and show it to our LPs, and they can make an independent decision as to whether they want to invest in you. We're going to save you 2 months, 3 months, 4 months in your time fundraising because we'll open doors to you. And guess what's even better? We're going to give it to you completely free. No fees. Now, you could argue, if you're a greedy bastard, and say, hey, but that's money on the table. You could charge for co-investment. You could charge carry on that. You could set up an SPV and make... But the reality of it is, does it benefit the ecosystem? Does it benefit founders? And your North Star should always be what is benefiting founders and their stakeholders, right? So in our fund, we decided that we would not charge any fees or carry on co-investment. As a result, when we lead a deal, pre-Series A, the deals close a lot quicker because our LPs co-invest with us. The founders spend less time fundraising, and these companies get to better revenue traction because the founders actually work on their companies, not on fundraising. And it selfishly benefits us and our LPs because we have better opportunities to create returns. So we may have dropped a few pennies on fees and carry, on co-investments, but the ecosystem has done better. You see what I'm saying around being penny wise and pound foolish? Right. Again, this isn't for everyone, but this is just something, this entire presentation is an FYI. Take it or leave it. Right. A lot of you as fund managers looking to raise capital understand that raising capital is hard, and sometimes you have to give a little to receive a lot. So have a clear mechanism in place for referral incentives, right? Incentivize people. So in our fund, almost 50% of our entire fund came through second and third degree referrals. But as much as we believe that human beings are good people intrinsically, and they are, ultimately, if you believe in fair value exchange, you allow someone a small amount of upside. But have it linked to your own funds. So as much as possible, make referral incentives convertible into equity in your fund and not just cash. Or give them the option to have a mix. But get people to work for you and become your biggest brand ambassadors. You can't do it yourself. You can. It might take you 5 years to raise a $100 million fund, but it might take you a year. But make sure you incentivize people. I can talk for hours about this particular slide. Cool. No, it's cool. It's figure of speech hours. Diversity and inclusion. Until about 5 years ago, the vast majority of funds in Africa, venture funds, didn't look like that. And diversity is gender, it's culture, nationality, age, race, it's everything. The average, people talk about diversity in portfolio companies. The average portfolio company in Africa has less than 2% female founders. But the importance of diversity is at 3 levels. It's at, what does your portfolio company situation look like? What does your venture team look like? Your GPs, your board, your IC, investment committees, your advisors. And what does your LP structure look like? Why don't we have more female LPs in funds? Why don't we have younger people as LPs in funds? So diversity is such an important part of a fund's performance and its likelihood to succeed. And it has to happen at all levels. The team, the portfolio companies, and the LPs. Our portfolio of 120 companies, 25% of these companies are women-led, and 91% of them are run, we are obviously a Pan-African fund, are run by African founders. Nothing against expat founders, but we believe that when we support African founders building solutions for the African continent, in the long run, it creates a better incentive for the next generation of founders. Diversity is extremely important, and I'd encourage everyone here, LPs, GPs, and founders, to make that a cornerstone of your company thesis. To your founders as GPs in the room, who knows what movie that is? Has anyone watched that film before? Any Given Sunday. Those of you who haven't watched it, please watch it. It's such an incredible movie. It's that speech from Al Pacino will literally leave you with, like, goosebumps. Be a coach to your founders, not a captain. VCs cannot run companies. VCs can coach companies. They can't run companies. The number of founders that have diluted so much that literally their VCs run their companies for them with all their preferential rights, liquidation preferences, participating rights. Ultimately, the founder literally sits there one morning on any given Sunday, no pun intended, and who runs a company? So VCs have to be disciplined and say, we're coaches, we're not captains. Guys, girls, watch this speech. It's called Any Given Sunday, Al Pacino. Incredible movie. Last couple of slides, and then I'm done. Work in Africa, the vast majority of companies, I'm almost done. The vast majority of companies that succeed in the tech startup space are B2B. So insurance companies, banks, retailers, telcos, extremely important. As a fund manager, make sure that you're constantly talking to champions of industry and introduce them to your portfolio companies. One of the most important things that founders often don't understand, and it's your responsibility as a VC to be constantly looking for ways in which you can introduce them to the heads of innovation at these large corporates. There we go. Founders will hate me for this. Don't be afraid to be the first to deliver news, good or bad, to your LPs from our perspective, or as founders to your investors. Contrary to popular belief, there is nothing wrong with delivering bad news. Just be the first one to say it. Don't let someone else tell it to them, because that's where you're a hypocrite. And it comes across as being disingenuous and hiding something from people. If any of our portfolio companies is struggling with regulation, with employee issues, we call our LPs. By the way, one of our companies is struggling with a Central Bank of Nigeria governance issue, and there's likely going to be some shit hitting the fan. We are working on it in A, B, and C. Straight up, honesty with your LPs. Transparent. You have no idea how LPs will respond to that in such a positive way, saying, oh my God, look at my GP or our GP. Good news or bad news, they communicate with us and they have an action plan for how to deal with it. In situations like that, even if the outcome is negative, you separate the journey from the destination, right? Extremely important for prospective GPs in the house is just do not be scared of bad news as long as you deliver it honestly and prudently. And the last couple of things, you cannot rest on your laurels as a fund manager. If not you, your venture partners, your analysts, you need to always be on top of what's happening in the industry. The rate of change of technology in multiple sectors, ed tech, health tech, AI, drones, sensors, there's new shit happening every day. And you cannot be a pertinent fund manager, or by the way, a founder, if you don't know what's happening in the industry. There's this classic American phrase, deer in the headlights. Oh shit, I don't know about this regulation. Oh, did that really happen? So you have to be on top of what's happening in your industry. If you don't, people will lose confidence very, very easily in you. Final slide. And this applies to founders, my favorite slide of all. I often get asked this question almost every day of my life. How the hell, Zach, do you, or just everyone, how do you balance your work and your life? People talk about work-life balance. Sorry to burst your bubble, founders. The concept of work-life balance is a myth. I repeat, work-life balance, repeat after me, is a myth. However, there's a big however, work-life integration is not a myth. What's the difference? The difference is when you talk to the people in your life that matter the most to you. Could be your children, your spouse, a partner, your parents, your co-workers, doesn't matter. But your non-work life needs to integrate with your personal life. If you have to work weekends, if you have to travel, just integrate it. Make it part of your being. And as founders and as fund managers, make time to do things that you love. Meditate. Meditate doesn't mean sitting on a hill with 9 cats around you and chanting smoke signals. No. Meditation could be music. Meditation could be writing. It could be running. It could be going for a swim. But if you do not take time as founders or fund managers for things that completely take you out of your work, you will burn out. And your investors and your LPs, in our case, will not forgive you for it. Right? Parents especially, right? So, just a few tips. That's me personally. I use music as a way to meditate, and I spend time with my daughter. But remember, you will never find work-life balance if you're an entrepreneur. If you want work-life balance, go work at PwC, or I don't know. Fuck. I hope PwC isn't a sponsor. Are they a sponsor? Not yet. No. But integrate your work into your life, and it will make you a better boss, a better employee, a better partner, a better investor. And that's how you run a fund. If you ever get a chance, and if you're intellectually curious about how you run your business alongside your life, there's an incredible book. It's called The 5 Agreements by a very wise man called Don Miguel Ruiz. Read it. I know everyone wants to read books, 0 to 1, the hard things about how hard things, and all these self-help books. Read them, but read books about life and personal development. This is an incredible book. I don't get royalties for this. I just really like the book. And as founders and fund managers, nothing is impossible. Nelson Mandela, one of my biggest heroes, said, "It always seems impossible until it's done." So thank you for listening to me.
Thank you, Zach. So we have time for 2 questions. 2 questions. 2.
Oh, questions. Ooh.
Yes, questions. 1.
Please ask tough questions. I hate easy questions.
Since you said tough, they only had easy questions. We have time for a question.
Come on, I'm not that intimidating. I'm wearing a biker jacket. Come on, I can't be intimidating.
Yeah, it was somebody. There was one there, right? No.
Zach, you're in a unique position of investing in many regions in Africa and many countries at early stage. So what are the differences that you are seeing and maybe the common like trends or and what can different countries can learn from entrepreneurs from different countries can learn from each other?
I get asked that a lot. Good question. On that point, I want to just say running a fund Pan-Africa is not easy, but always, as this is true for founders as well, always use other people's networks above yours, right? So as a fund, we were able to do deals in Egypt and Tunisia as effectively as we can do deals in South Africa and Nigeria. So we work with a team of advisors that aren't paid for by us, but they work on behalf of our portfolio companies, and they sit on the advisory boards of our portcos. So we have an Egypt expert, a Tunisia expert, a fintech expert, and they are accountable to us, but sit on the boards of our portfolio companies. So that's how we can work with the efficacy of a $100 million fund, but with the resources of a $25 million fund, $30 million fund. But differences in how can founders benefit from other founders? We're seeing it a little better now in Africa, but way too many founders in, let's say, for example, Tunisia or Egypt have no idea what's happening in Nigeria. Or people based in Kenya have no idea what's happening in South Africa. And it's amazing the commonalities between founders in these regions is so high. And when founders actually get to meet each other in conferences like Africa Arena, the similarities are so huge. And we see such incredible outcomes when people meet, when founders meet. So the one thing I would say in that point is there is a difference in the DNA of founders when it comes to how hard do I hustle, right? In Nigeria, every second coffee shop, you have people coding, people just ambitious, right? Good luck with seeing people at a coffee shop in Cape Town doing that, because it's an easy life, right? So founders need to see, okay, what are the, so Nigeria is known for a very prominent fintech sector. Kenya is known for a very prominent telco sector because of M-Pesa. South Africa has a very strong insurance industry for lots of reasons. Egypt and North Africa tend to be very good in supply chain, logistics, and increasingly e-commerce. So I think founders need to spend time with other founders outside of their comfort zone. It is very hard for you as a founder to get to $100,000 to $200,000 in monthly recurring revenue, which is when you tend to be ready for a Series A round, unless you're in more than one market. The cost of expanding into different markets is often prohibitively high. So you've got to understand, how can I get access into other markets without having to spend a lot of physical resources on the ground? And there are 2 or 3 ways of doing that. One is you work with other fintechs or logistic tech or other companies like yourself and add value to them through license agreements, through revenue sharing agreements, right? The other way is you work with large corporates that have a presence in multiple regions. So one of the benefits of scaling a startup in Africa versus Europe, for example, I mentioned this at VivaTech in Paris 3 months ago, and it was a big shock to everyone. In Africa, you've got 3 major business languages: English, French, and Arabic, right? And from a telco perspective, you got 4 or 5 telcos. You got Airtel, MTN, Orange, Vodacom. You got 4 or 5 major banking conglomerates. Same thing with insurance. So if you're able to have a solution that works in your home market, talk to your corporate partners. Go and hold your corporate partners accountable as much as you hold your VCs accountable. Startup founders are so, not ashamed, but they're so scared to ask for help. If you're in Ghana, for example, and you're working with Stanbic, and you're building, let's say, a peer-to-peer wallet for Stanbic customers in Ghana, before you open up an office in Nigeria or Kenya or in South Africa, go and talk to Stanbic. I'm just giving an example, right? So you've got to be able to expand into multiple markets through your corporate partners or through other tech startups. And the ones that do that pre-Series A or at Series A are the ones that tend to have much higher traction. So I'd encourage a lot of Tunisian startups, since we're here, to just be aware of what's happening in other parts of the continent and talk to startup founders to see how they can help you. I don't personally believe that there is any such thing as pure 100% direct competition. There's always an overlap for synergies and leverage off of other people's networks and other people's resources. Right. If that helps. Another question? Tamam?
That was the last question.
One final question from the...
It was taken already.
The gentleman from Khartoum, no? Oh, crap. Okay. Faris.
Thank you, Zach.
Sure.
My name is Faris from Smart Capital. I think Launch Africa is very unique in a sense where it invests at a very early stage across the continent. And also, I think the structure of your fund is interesting since you're dealing with 238 LPs.
You listened to my presentation. I like it.
I always ask you about these questions.
Yeah.
And I wanted to know how to convince LPs that you can invest across the continent without losing focus.
Mm-hmm.
And also, what are the things that you told them to make sure that they understand that your interests are aligned? And the last one, what were the things that you left on the negotiation table that when you entered, you thought that you were going to keep?
No, great questions. I'll try and be quick here. How do you manage 238 LPs? Like I mentioned in one of my earlier slides, there has to be a line where you cannot let your LPs control the conversation, right? But you give them all that they need and better and more, but you cannot have them dictate the conversation. So in our case, we have 238 LPs. Not a single LP in our fund has extra privileges. We have an LP, a very prominent LP, a very big corporate in Europe that has invested, that owns 8% of our fund. They have the exact same rights as someone that has a $100,000 check in a fund. And we explained why we can't have preferential treatment. And we were prepared to have them say no. A lot of founders and fund managers are so scared of losing money because they can't satisfy every single whim and fancy of their LPs or their investors, whichever way you look at it. You gotta be okay with saying no to money. We said no to almost $8 million because it wasn't the right strategic fit for us. So over-communicate, but know where the line is. That's how we've dealt with our 238 LPs. How do you manage 100 plus companies? You have to work smart, you can't just work hard, you have to work smart. So like I said, we've got 30 plus advisors that are region, product, and sector experts that work on behalf of our portfolio companies. So we don't have to use our paltry 2% management fees to pay them. But our portfolio companies benefit significantly from their expertise, and they get advisory equity in our portcos. So we work with the efficiency of a $100 million fund with the capital of a $20, $30 million fund. That's one aspect of it. But we work very closely with the top accelerators. So, I mean, Philip and I think Philip's left. We used to run Startup Bootcamp, and we work with Y Combinator, Techstars, Founders Factory, all the big accelerators, because their KPIs, I'm going to finish in 30 seconds. You can start counting me down. their KPIs are how many of our portcos are ready for the next rounds of funding. So we make sure their KPIs are met, right? And the last question, I think I'll just answer offline because I'm going to get shot from Christoph. Thanks, guys.